Okay, folks, so we've got a lot to talk about. Number one, it is officially squeeze season. Happy holidays. As you know, if you watched Thursday's video, I took a long weekend trip to Vancouver. As I was gone, the new squeeze trend has heated up in a massive way, with stocks like BBBY, AMC, and GME, and others realizing some upside. We will discuss what is making this new squeeze season start and what you can expect moving forward. Number two, we have something massive coming tomorrow, and you already know what it is. No beating around the bush. It's the CPI report, or as I like to call it, the Consumer Poverty Index, the rate at which consumers like you and I are getting poorer. And this report has a huge impact on the market because of its inherent relationship with what the Fed's going to do. And as of right now, the market is testing a break above its previous bear market rally. If it extends, it'll break what is currently being held as a double top. The news tomorrow on the CPI will be of paramount importance to the direction of the market and what we see over the coming weeks heading to the next rate hike decision meeting. Markets right now are still in this trance of expecting the Fed's front-loaded hikes to end by the end of 2022, and into 2023 you start actually seeing cuts, at least based on what the Fed futures are showing. But the minute that inflation challenges that narrative, you could see a flipperoo, a 180 in the market and the calm that we've been seeing. We will discuss exactly what is expected heading in tomorrow and what you need to know and get ready for. Also, this video is brought to you by Moomoo and their 10 free stock promotion, but more on that later. They have extended it through the summer, which is very exciting. Okay, so let's go ahead and start with the meme revenge trade. So you've seen your Ooga Booga AMC, your GME, and your BBBY have some of their most significant breakouts we've seen since the March bear market rally. And Bed Bath & Beyond really took us to the Beyond section yesterday, with a 40% pump in a day and 9 consecutive days of gains. It broke that today, but overall you've seen a very, very big resurgence. And as the great Greek philosopher Plato once said, one meme tide lifts all meme boats. And overall that is exactly what happened, and people say that philosophy is no longer relevant. But overall, what has caused these and other meme squeezers to really skyrocket and the tide come out and lift all these boats? And will this trend continue? How long is this latest meme revenge rally going to last? Well, the way that I see it is that there's certain criteria that a meme revenge rally cycle follows. The environment that causes squeezers to do well, especially meme revenge squeezers with a huge name recognition behind them, is an environment where you have, number one, overall quieting of macro fears, number two, some climbing or at least stability in the overall markets, causing net pressure overall on shorts. Three, you need a first mover that moves rapidly and induces people to anticipate the next squeezers because they saw the proof of concept in the first one. Whatever the first stock is, if it runs massively, all of a sudden people are like, hey, well, what is the next stock that's going to run massively? And that causes capital to start chasing other stocks with similar criteria, and then you get a much bigger wave of squeezes. Number four, you need speculators returning to the market to take advantage of heightened opportunity. Generally speaking, if you get 2 or 3 weeks of sustained squeezing rallies that cause massive gains, all of a sudden people start noticing and they're like, hey, it's time to get back in the market and take advantage of these. And then all of a sudden you get more and more capital, right? And then number five, you need a continuation of these variables to some extent, with leading meme revenge stocks continuously breaking out or having new catalysts keeping the trade relevant. If the market is convinced that there's no new opportunities, well, that becomes a self-fulfilling prophecy, and there's less capital chasing these stocks, and that means less opportunities for what markets want to see is the potential for massive gains, right? And obviously in the last 3 to 4 weeks, you've actually seen each of these criteria be hit. And if you want to predict whether or not an individual meme revenge stock is going to do well, pay attention to these overall drivers, because this is the framework to dictating whether or not there's another tide coming and whether or not the tide that's already out isn't just going to be pulled back. You see a single change in the overall market environment or the return of macro fears, and a lot of that spec capital can quickly retreat just as quickly as it came in, right? And of course, as with most things, understanding the context is very, very important. During a bear market rally, who are the players that have the most liability? Well, short sellers who are aggressively short different stocks that are rallying. Even if you're right on an overall bear trend and you're right on the underlying fundamental bearish variables, well, hey, we've seen some bear market rallies that have lasted upwards of 5-6 months. Just look at the dot-com bubble. You saw one with 3 months of uptrending and another one with 6 months. These days, if you get 2 or 3 weeks of a rally, people are already ready to call it back to all-time highs. Imagine 6 months of an uptrend that just then goes and makes a new low afterwards. Oof. So essentially, short sellers that get caught in aggressive uptrends like we've seen over the previous period, well, oftentimes in order to risk manage, they'll have to consolidate their positions. And as of right now, the data suggests that shorts are sitting on on a massively negative profit margin, specifically when looking over at the NASDAQ. So if you're sitting on huge NASDAQ-related short positions or overall tech-related short positions, well, ouch. All of a sudden, you may need to start consolidating into positions that are your highest conviction to short, or you may decide, hey, you know what, it's enough, I'm going to close the trend trade now, and then come back when the direction is back in my favor. Aside from that, the situation is also very historically relevant, and we're making some new records. The jump in stocks like Bed Bath & Beyond, AMC, and meme poster stock GameStop helped push the GS Most Short Index 5-day change to up 18%, which is the highest since January 27th, 2021, which was peak short squeeze market environment. You look at what that looks like on a chart, I mean, you're seeing historically significant indications that match what you saw during 2021's most infamous meme revenge rallies. And the reason is pretty straightforward. It's because we've so quickly switched from an aggressive downtrend to this overall rally that has caused a whiplash effect where bears weren't prepped for such a rebound. And obviously, if you go back to what we were talking about 3 weeks ago when we talked about the massive flip coming, the Fed at that point, and although they've walked it back a little bit, but the Fed at that point had signaled, hey, even if inflation is hot heading into the fall, we're still not going to be doing much more in terms of rate hikes. We actually think that we should start cutting back some. Each consecutive meeting is going to be a hike less than the previous. And that was a complete flip because all of a sudden you went from this environment of hotter and hotter and higher hikes to now lower and lower hikes. And eventually, no more hikes by the end of the year. Now, obviously, as we get the CPI report tomorrow, we're going to get more indications as to whether or not the Fed can afford to follow that trajectory. But obviously, for short sellers that were betting on higher and higher rate hikes, well, this new trend of the Fed saying, no, we're actually not going to be as aggressive as we probably should be, well, that's been terribly detrimental to short sellers, right? So you got that whiplash effect where all of a sudden these short sellers have had their rear ends handed to them. Obviously, if the Fed wants to, they can make a comment 3 days from now that pivots once again, and all of a sudden these short sellers are sitting on a massive gain, which of course leads us to the next point of this video, which is the big report that is coming out tomorrow, Mr. CPI. But first, a word from our sponsor Moomoo and their 10 free stock promotion that they just extended. The market is ruthless, and so you better be prepared to fight with the best tools available to you. You better have a platform that allows you to do top tier risk versus reward analysis on the spot, allows you to gain rapid insights, and of course helps you find and execute on effective strategies. Folks, you need a platform built for elite and active traders just like you. And that is where Moomoo comes in. Moomoo helps you monitor market movements, perform deep technical analysis, quickly screen for stocks that meet your criteria, and also provides a community where traders can exchange ideas amongst one another. Moomoo offers crucial features like fast fills, AI monitors, AI price predictions, heat maps, stock compares, and of course, candlestick screening searches. Moomoo is a one-stop trading app that gives traders everything they need to get that edge on the market. If you are looking to step your trading game up to the next level, make sure to give Moomoo a look. And we've arranged where if you sign up using our link down below, you'll get up to 10 free stocks. That's right, folks, 10 free stocks for trying out an excellent trading app. Sounds like a good deal to me. Thank you, Moomoo, for sponsoring this video. Now back to the content. Okay, so tomorrow, 8:30 a.m. Eastern Time, the CPI report for the month of July will be released. What is it that you should know? Well, you should know that you are being robbed by the insane mishandling of the US dollar. But of course, I'm just stating the obvious there. What you do need to know is there's a lot hanging on this report. I don't want to sound like a broken record, but the narrative that has allowed the market to rally is the narrative that inflation is peaking and the Fed's hikes will be over by the end of the year. And if inflation is showing any sign of not peaking, then that's going to turn the market back into a whirlwind. And let me be completely clear, the standards that inflation has to meet tomorrow are very easy and very simple. The last report showcased 9.1% inflation year over year, 1.3% month over month. The consensus estimate on Wall Street for tomorrow's report is 8.7% year over year and a 0.2% month over month increase, which means that the standard heading into tomorrow is that we not only maintain all of the pricing pressures that we had over the last month and of the last 6 months that were insanely hot, largely because of commodity prices. Not only do we maintain all those pricing pressures, even though commodity prices have gone down in July, but we also continue to build onto that. Core inflation, which is minus food and energy, is expected to go up 6.1% year over year versus the 5.9% it went up year over year when looking at the last report. If you plot these on a chart, the CPI all items is expected to come down a very slight bit, and the core inflation all items less food and energy is supposed to go up a bit. If this doesn't sound like a low barrier to meet, I don't know what does. And by the way, look very, very carefully at how tomorrow's report is commented on. Back in previous reports, what would they say? They'd say, oh, all items, you shouldn't care about that. That doesn't matter. Who cares that that's skyrocketing? Because the only thing that really matters for you is the core inflation. The core minus food and energy, which are too volatile to be in our calculation because we can't lie about them. Well, guess what? Now that commodity prices are going down, what are they going to say? They're going to say, oh, you shouldn't care about the core inflation that's going up. Who cares that core inflationary prices are spiraling out of control? But anyways, what are the odds of overall CPI going down and this marking a peak heading into this report? Well, of course, commodity prices in July dumped, which was fantastic. Crude oil prices had dumped in July. They continued dumping into August. Unleaded gas, same thing. Natural gas actually had an advantage going into July at a low, but then started increasing throughout the entire month, although the baseline average wasn't terrible. Going into food commodities, corn just dumped going into July. Wheat was already dumping into June, but continued consolidating into July. Fertilizer price also dumped. Cows have been pooping up a storm. Point is, overall commodities are on a very healthy downtrend, and that is very, very positive in terms of bringing down inflation and commodity prices, right? The problem is, though, that you're starting to see a bit of a spiral in other areas. I would argue the biggest threat for inflationary pressures moving forward is not in the commodity chain, at least not right now, but is in wage growth. Obviously, it's well documented that wages are not keeping up with inflation, but they are going up pretty dramatically. And the labor market is still pretty damn tight. It actually just reported that it was tighter than most economists had thought. Companies are spending more and more money to attract employees. The more that companies have to pay to attract employees while their other input costs are going up also means the more that they're going to attempt to pass on to consumers. The much feared wage price spiral. According to the Wall Street Journal, average hourly earnings grew 5.2% in July from a year earlier, and annual wage gains have exceeded 5% each month this year, the Labor Department said Friday. The rapid earnings growth adds to the other evidence that employers are continuing to increase pay as they try to find and keep workers in a tight job market. Higher wages and job growth combined with a contraction in overall economic output are weighing on labor productivity. We are in this weird situation right now where jobs are growing, wages are growing, but at the same time, there's a dramatic contraction of economic output. Labor productivity is going down. Put another way, companies are paying more and more to produce less and less. Pretty much inflation in a nutshell, right? And what do companies do when they have to pay more and more to produce less and less? Well, they raise prices, and then you get another spiral cycle. So anyways, when you're looking at the inflation report tomorrow, obviously pay attention to the overall number, but pay very, very close attention to every line item that is related to human labor. It looks increasingly like anything commodity related is going to be on a downtrend, at least for the next couple of reports, but anything involving human labor is still going to be heating up, which is very, very problematic. Anyways, we will see what happens tomorrow. Again, that comes out 8:30 a.m. Eastern, so in the pre-market. That caps off today's video. Let us know what you think down below. Is inflation at a peak, or are we in for a fall of more inflationary pressures? Is the Fed going to continue raising rates into 2023? Let us know what you think. Thank you, Moomoo, for sponsoring us today. If you want to get your up to 10 free stocks with our link down below, make sure to do that. If you want to get 50% off lifetime access to ZipTrader U and our step-by-step lessons, private chat, daily morning briefings, as well as our full price target list, I'll put a link to ZipTrader U below. Coupon code recession50 will get you that discount. Have a good one, folks, and I'll see you in the next video.